Thank you for listening to the Council of Institutional Investors Voice of Corporate Governance, the #1 corporate governance podcast in the U.S. as determined by Million Podcasts. I'm your host, Jeff Mahoney, General Counsel of CII. The purpose of these monthly episodes is to update CII members and the general public on significant developments in corporate governance and capital markets regulation and CII's related advocacy activities. This update covers the period from January 6th to February 3rd, 2026. The following is my top 10 list of events over that period. Number 10, on January 8th, U.S. House of Representatives Frank Lucas of Oklahoma and Brittany Peterson of Colorado introduced a bill to establish within the U.S. Securities and Exchange Commission a public company advisory committee. The bill, H.R. 6967, the Public Company Advisory Committee Act, would create a committee that provides advice on the SEC's existing and emerging regulatory priorities, issues related to the public reporting and corporate governance of public companies, as well as issues related to the proxy process, trading of public company securities, and capital formation. Under the bill, the SEC would appoint between 10 and 20 members of the committee, with at least half of members being officers, directors, or senior officials of public companies registered with the commission, except for those public companies that own asset management, fixed income, investment advisory, broker-dealer, or proxy services businesses. The bill's text says other members of the committee would be individuals with senior managerial responsibility in business, professional, trade, and industry associations that represent the interests of such public companies, as well as professional advisors and service providers to such companies. Committee members would serve 4-year staggered terms, with half of the initial members serving 2-year terms. Members would elect a chair, a vice chair, a secretary, and an assistant secretary. The committee would meet at least twice annually, and the SEC would review the committee's findings with the requirement that the SEC promptly issue a public statement after receiving a finding or recommendation from the committee. On January 22nd, H.R. 6967 was approved by the U.S. House of Representatives Financial Services Committee by a 39-15 vote. Representative Lucas introduced a similar bill in 2023 that never moved out of the Financial Services Committee. As of the date of this podcast recording, it's unclear whether H.R. 6967 may be voted on by the full U.S. House of Representatives. Number 9, on January 15th, the U.S. House of Representatives passed by a vote of 213 to 205 H.R. 2988, the Protecting Prudent Investment of Retirement Savings Act. H.R. 2988 was introduced on April 24th by Representative Rick Allen of Georgia. H.R. 2988 would override a 2022 Department of Labor rule allowing fiduciaries to consider environmental, social, and governance factors in their decision-making. Moreover, Representative Allen's bill would reinstate many of the provisions in a final rule published by the Employee Benefits Security Administration in December 2020. The legislation specifies that fiduciaries of private pension plans must base investment decisions and cast proxy ballots based solely on pecuniary factors. In addition, the bill would require pension plans to warn participants about the risks associated with non-standard investments and to hire employees and engage service providers without regard to race, color, religion, sex, or national origin. Representative Allen said in an April news release, quote, Americans' hard-earned retirement savings should never be jeopardized by politically motivated mismanagement. Unfortunately, the Biden-Harris administration made this possible with an overreaching rule that allows fiduciaries to aggressively invest retirees' money in ESG funds, which often charge steeper fees, carry higher risk, and have lower returns, unquote. A coalition of 50 labor unions, investors, and public interest organizations led by Americans for Financial Reform sent a letter on January 13th to members of the U.S. House of Representatives expressing strong opposition to H.R. 2988. The letter says the bill would undermine workers' retirement security in at least four ways. One, chilling fiduciaries' consideration of a slew of important financial risk and opportunities. Two, undermining prudent investments that generate collateral benefits for beneficiaries in addition to financial returns. Three, silencing workers' voices in the governance of companies they are invested in. And four, stymie efforts to increase value by diversifying retirement plan service providers. The U.S. House of Representatives passed similar legislation in 2023, but the U.S. Senate did not consider it. As of the date of this podcast recording, it's unclear whether the U.S. Senate will consider H.R. 2988. Number 8. In a January 22nd statement, U.S. Securities and Exchange Commission Chair Paul Atkins announced that he is cutting the Public Company Accounting Oversight Board's $362 million budget by 9.4%, a reduction of $37.6 million from last year's allotment. Chair Atkins also said he's reducing the PCAOB chair's salary by 52% and board members' pay by 42%. Chair Atkins said this action demonstrates a clear commitment to aligning PCAOB pay more closely with the ethos of public service that reinforces trust, demonstrates financial responsibility, and affirms the honor of stewardship over the capital markets. The PCAOB's chair's salary currently stands at $673,000 and board members at $547,000. In July, Chair Atkins appointed George Boddick to serve as acting chair of the PCAOB and solicited candidates for all 5 PCAOB seats, including the chair. When announcing the budget cuts, the SEC chair also said he plans to work with the PCAOB on a long-term strategic plan that will get the PCAOB back to basics, focusing on integrity and objectivity of the profession, reducing unnecessarily complex regulations, and recentering this important institution on its core statutory responsibilities. On January 30th, the SEC announced the appointment of Dimitrios Logothetis as chairman and Mark Calabria, Kyle Hauptman, and Stephen Lawton as board members of the Public Company Accounting Oversight Board. George Boddick will continue his service as a board member and will remain as acting chairman until Mr. Logothetis is sworn in. Number 7. In a January 23rd letter to the U.S. Securities and Exchange Commission, the International Corporate Governance Network raised concerns about the SEC's November 17th announcement that its Division of Corporation Finance this proxy season would generally not be weighing in on no action requests from companies seeking to exclude shareholder proposals from their proxy statements. More specifically, the International Corporate Governance Network letter indicated that the November 17th announcement, combined with the SEC's recent changes to its interpretations of when investors must file 13D and 13G forms, risk adding tensions between company owners and management and diminish investor confidence in U.S. corporate governance standards and thereby weaken the appeal of U.S. capital markets globally. The letter also warned that without the no-action process, boards of directors may face increased opposition from investors whose proposals have been omitted without a valid reason. Furthermore, the letter said companies may be exposed to increased litigation as proponents of resolutions that have been omitted by companies may seek judicial clarification. In conclusion, the International Corporate Governance Network letter expressed concern that the SEC is enacting major changes, largely removing itself from the no-action process without going through the formal rulemaking process. The group encouraged the SEC to return to public consultation processes on matters that substantially alter policy following a formal notice and comment process under the Administrative Procedure Act. In a January 22nd public statement, the Interfaith Center on Corporate Responsibility reiterated the International Corporate Governance Network's warnings, saying that some investors might vote against directors of companies that unilaterally omit resolutions, while others might present their proposals on the floors of shareholder meetings instead of in the proxies, and still others may pursue legal action in federal court. The Interfaith Center on Corporate Responsibility statement explained, certainly shareholders do not prefer such alternatives. Instead, we continue to believe that dialogue and the search for a win-win agreement by which a resolution can be withdrawn is in both the company's and its investors' best interests. The group also urged the SEC to return to its established no-action process. But if it does not do that, the Interfaith Center on Corporate Responsibility pressed companies to reconsider exclusion notices after input from proponents to avoid undercutting productive relationships between companies and their shareholders. Number 6, on January 26th, the Shareholder Rights Group Director, General Counsel Sanford Lewis, and its Associate Counsel, Khadija Fada, published a critique of the Weinberg Center for Corporate Governance recently published survey on shareholders and companies' views on Rule 14a. The author's critique argues that the way the survey results were portrayed by the Weinberg Center's narrative accompanying the survey results did not reflect the actual data. The authors write, while the survey generated some useful data, unfortunately, the report's interpretive analysis is marred by errors and selective framing, despite being framed as an effort to center on facts that can inform shareholder proposal reform discussions. The authors caution the survey's distortions risk materially misinforming such debates, and therefore we believe that the SEC and other policymakers should not rely on the report's narrative description of its findings when evaluating any changes to the shareholder proposal process. The author's critique takes issue with the narrative accompanying the survey results, including the following 6 items. 1, the blog post by Lawrence Cunningham, the director of the Weinberg Center for Corporate Governance, promoting the survey results, contends that, quote, one of the report's most striking findings is the breadth of dissatisfaction with the SEC's administration of Rule 14a8. Unlike views on the legitimacy of proposals, dissatisfaction with this process itself is widespread and consistent across respondents, unquote. However, the author's critique notes that of the 166 respondents to the question of how fair is the SEC's shareholder proposal process to all parties, 20 selected very fair, 38 selected fair, 42 selected somewhat fair, 24 selected unfair, 33 selected insufficient basis to judge, and 9 selected other. In other words, a majority of respondents to this question, around 60%, said that the SEC's shareholder proposal process was somewhat to very fair to all parties. Number 2, the narrative accompanying the survey results indicates that most shareholder proposals never reach a vote, instead being resolved through withdrawal or the SEC's no action process, and that when proposals do reach the ballot, they rarely receive majority support. This is characterized as being inconsistent with shareholder democracy. The author's critique says that that conclusion reflects an interpretive choice that downplays the important role of engagement, transparency, and negotiated change in producing private ordering through the proposal process. Number 3, the survey asked companies for total costs of shareholder proposals over 4 years. However, the narrative accompanying the survey results describes these 4-year costs as annual costs, leading to distorted conclusions. 7 respondents reported less than $100,000, and 6 respondents reported between $250,000 and $500,000. 5 respondents reported costs above $500,000, and 4 respondents reported spending more than $1 million. When divided across 4 proxy seasons, these figures imply approximate annual costs of $25,000 or less, $25,000 to $62,500, $62,500 to $125,000, more than $125,000, and more than $200,000, respectively. Number 4, although the survey does not include questions about quantified benefits of shareholder proposals, in response to a question about the benefits of shareholder-sponsored proposals, almost 62% of respondents selected benefits were in the range of modest to irreplaceable, whereas 34% selected minimal benefits as an option. Moreover, almost 51% of respondents selected yes in response to the survey question saying, overall, do the benefits of Rule 14A8 outweigh its costs? Number 5, survey respondent support for environmental, social, systemic risk, and political proposals remains substantial, often in the 30% to 50% range. Despite these survey results, a narrative accompanying the survey results concludes that support declines as topics move further from traditional governance and firm-specific economic oversight, mischaracterizing both the nature of these proposals and the levels of respondent support. Number 6, the narrative accompanying the survey results states respondents were split about whether to retain federal authority over the shareholder proposal process or devolve responsibility to states. But the actual survey results show nearly 70% of respondents favor retaining Rule 14A-8 at the federal level. When asked about their preferred long-term approach, only 13% or 29 respondents favored devolution to the states, and only 11% or 25 respondents favored permitting each company to find its own proposal rules. Number 5, the staff of the U.S. Securities and Exchange Commission announced on January 23rd that it will be objecting to the use of exempt solicitations by smaller shareholders. SEC rules require any person who engages in an exempt solicitation relating to a shareholder vote at a company and owns more than 5% of that company's stock to file a notice of exempt solicitations using SEC's EDGAR public filing system. Previously, SEC staff did not object to voluntary submissions of exempt solicitations by those not meeting the $5 million ownership requirement. The change, which was implemented through a revised answer to question 126.06 of the SEC staff's compliance and disclosure interpretations regarding proxy rules, said the voluntary submission of such notices on EDGAR appears to be primarily a means to generate publicity. The SEC staff added that staff is concerned by such widespread use of a commission filing for reasons other than its intended purpose, and accordingly, the staff will object to a voluntary submission of a notice of exempt solicitation. A July 31st, 2025 proxy season preview by the corporate law firm Sullivan & Cromwell finds there were 220 exempt solicitations submitted to the SEC in the first half of 2025. A substantial majority were voluntary submissions, and just 5 frequent shareholder proponents accounted for 113 of these filings. In response to the SEC's announcement, a press release was issued by As You Sow, which said, by unilaterally withdrawing this provision without public notice, rulemaking, or shareholder input, the SEC is narrowing the flow of material information shareholders rely on prior to a vote, the time when investor engagement and transparency are most needed. January 28th, representatives of the Shareholder Rights Group and other organizations, including Ceres, AFL-CIO, Interfaith Center on Corporate Responsibility, and As You Sow, met with representatives of the SEC's Division of Corporation Finance to express concerns about this new policy, as well as other recent developments that they believe undercut shareholders' rights. Sanford Lewis, Director and General Counsel of the Shareholder Rights Group, said, the SEC's EDGAR database is the leading public forum and record for disclosures regarding upcoming annual meeting votes. The new measure strikingly tilts the playing field and this public record, allowing companies to post to the SEC and record their solicitations regarding support for shareholders or other company initiatives in opposition to shareholder proposals, but cutting off access for most investors to respond. Lewis urged the SEC's Division of Corporation Finance to immediately reverse this change in how it oversees exempt solicitation. Number 4, on January 13th, the U.S. Securities and Exchange Commission Chair Paul Atkins requested feedback on possible reforms to Regulation SK, which determines many public company disclosures outside of the financial statements, including the following 8 items. 1, business descriptions. 2, legal proceedings. 3, risk factors. 4, management discussion and analysis. 5, executive compensation, 6, related party transactions, 7, board and committee information, and 8, security ownership. Chair Atkins said, I welcome and encourage members of the public to provide their views on how the Commission can amend Regulation SK with the goal of revising the requirements to focus on eliciting disclosure of material information and avoid compelling the disclosure of immaterial information. In 2016, the SEC issued a concept release on Regulation SK, culminating in related rulemakings during the tenures of former SEC chairs Mary Jo White and Jay Clayton. Generally, these amendments shifted SK requirements toward a more flexible, principles-based approach. Chair Atkins' review could lead to a proposal to revise executive compensation disclosures. However, the SEC chair's statement notes that the Commission staff will focus on other aspects of Regulation XK as a next step. Comments on the SEC's possible reforms to Regulation SK will be accepted by the SEC through April 13th. CII currently plans to submit a comment letter in response to the request. Number 3, on January 26, speaking at the 53rd Annual Securities Regulation Institute, Commissioner Mark Ueda of the U.S. Securities and Exchange Commission suggested that as part of a comprehensive review of Regulation SK, the SEC could consider deleting the Item 408 requirement that companies explain whether they have an insider trading policy or provide reasons if they do not. Commissioner Ueda added this would not change any underlying federal securities law obligations or liability thereunder, but would simplify disclosures. Commissioner Ueda also suggested changes to Regulation SK Item 404, which requires companies to disclose transactions since the beginning of the last fiscal year in excess of $120,000 in which the company was a participant and any related person had or will have a direct or indirect material interest. A related person includes any director, director nominee, or executive officer of the company, as well as any immediate family member. Commissioner Ueda said the Commission could consider adjusting the de minimis threshold to a higher amount or replacing a static number with a more principle-based approach to materiality. Commissioner Ueda also said that Item 106, which requires companies to provide standardized disclosures regarding cybersecurity risk management, strategy, governance, and incidents, could be streamlined. Commissioner Ueda added, our disclosure rules should generally not be the driver for what a company does or does not do, but disclosure requirements such as these and others are likely shaming or indirectly compelling companies to change practices rather than eliciting material disclosure as to what the company is doing. Number 2, a January 20th decision by the Delaware Supreme Court let stand an agreement between Moelis and Company and its founder, chair, and CEO, Ken Moelis, that contains certain provisions granting a controlling shareholder broad powers over the board. The underlying opinion in West Palm Beach Firefighters Pension Fund versus Moelis and Company, written by Vice Chancellor Travis Laster in February 2024, invalidated certain provisions of the agreement, including those requiring the board to obtain the founder's approval before issuing stock, declaring dividends, and approving annual budgets. Vice Chancellor Travis's decision cited Section 141A of the Delaware General Corporation Law, the pole star of Delaware Corporation Law, which states the principle that the business and affairs of every corporation organized under this chapter shall be managed by or under the direction of a board of directors, except as may be otherwise provided in this chapter or in its certificate of incorporation. Moelis had argued that the pension fund bought a stake in Moelis and Company in 2014, but waited until 2023 to sue over the provisions of the agreement, violating Delaware's 3-year statute of limitations for similar claims. Vice Chancellor Laster's decision reasoned that if these provisions violate Delaware law, they are completely void, and the time frame in which the pension fund filed its lawsuit should not matter. Within months of Vice Chancellor Laster's ruling, the Delaware General Assembly passed Senate Bill 313, which explicitly allows Moelis types of stockholder agreements, even if they limit what boards can do. Counsel for Institutional Investors vigorously objected to Senate Bill 313. The Delaware Supreme Court ruling said Vice Chancellor Laster erred when he determined that the West Palm Beach Firefighters Pension Fund was not required to sue within 3 years of the 2014 MOLAS agreement because the arrangement amounted to an ongoing violation of Delaware law. The ruling also erased a $6 million legal bill that Moelis and company would have owed if Vice Chancellor Laster's lower court decision had stood. And my number one most significant development in U.S. corporate governance and capital markets regulation for the period from January 6th to February 3rd occurred on January 13th, when the Council of Institutional Investors submitted a comment letter to the U.S. Securities and Exchange Commission expressing continued support for a Nasdaq proposal to impose new listing standards for Chinese companies. The CII letter, however, also recommends adding an amendment to the proposed listing standards to include companies incorporated in the Cayman Islands or other countries of concern for fraudulent activity. Under Nasdaq's proposed listing standard change, any new public offering by a Chinese company must meet a $25 million threshold to proceed. CII sent its letter in response to a public comment period for the SEC's approval of the proposed rule. CII's views in the letter build on previous advocacy correspondence and research. For example, in October, CII wrote to the SEC about Nasdaq's proposed listing rule, expressing general support for new listing requirements for Chinese companies. In September, CII recommended to the SEC revise the definition of foreign private issuer to reflect that most foreign private issuers today are headquartered in China, incorporated in the Cayman Islands. CII research notes that many Chinese companies list in the U.S. through a Cayman Islands proxy, which can complicate potential enforcement actions. Many investors may not fully understand a company's true ties to China, or how ownership or jurisdiction may not accurately represent business operations. Under CII's policy on incorporation and reincorporation, approved by CII members in March 2025, companies are discouraged from incorporating or reincorporating in jurisdictions that weaken shareholder rights. The Cayman Islands is widely viewed as a jurisdiction of concern due to weaker transparency and investor protections relative to U.S. incorporated companies, enforcement challenges for U.S. authorities, and limited accountability for wrongdoing by directors and officers. In an October 2025 CFA Society of New York webinar moderated by CII General Counsel Jeff Mahoney, Professor John Coates of Harvard Law School ranked the Cayman Islands as the worst jurisdiction for investor protection when compared to Delaware, Nevada, and Texas corporate laws. That completes my monthly update on significant developments in corporate governance and capital markets regulation. If you have any questions regarding any of the issues discussed, please feel free to email me at Jeff, that's Jeff, at CII.org. Until next time, I'm Jeff Mahoney. Thanks again for listening to the Voice of Corporate Governance.
Thank you for listening to this episode of The Voice of Corporate Governance, brought to you by the Council of Institutional Investors. The Voice of Corporate Governance is a free, non-sponsored podcast that highlights critical developments in corporate governance and other important issues affecting institutional investors. The views expressed by those interviewed on the podcast do not necessarily reflect the views of CII or its members. For more information on CII and its policies on corporate governance, please visit our website at www.cii.org.